This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
MacroVoices episode 441 was produced on August 15th, 2024. I'm Eric Townsend. Quadriga CIO and noted author Diego Parrilla returns as this week's feature interview guest. We'll discuss all the usual macro suspects, from whether the recent equity market dislocation was just a flash in the pan or the start of a new bear market, Diego's outlook for inflation, commodities, precious metals, and more.
And I'm Patrick Ceresna with the Macro Scoreboard week over week as of the close of Wednesday, August 15th, 2024. The September S&P futures up 478 basis points, trading at 54.77. The market continues to recover from the carry trade carnage. We'll take a closer look at that chart and the key technical levels to watch in the postgame segment. The US dollar index down 59 basis points to 102.57. The September WTI crude oil contract up 233 basis points, trading at 76.98, recovering from oversold conditions. We'll take a look at that chart in the postgame, and Eric will have the EIA inventory data. The October RBOB gasoline down 92 basis points, trading at 215. The December gold contract up 131 basis points, trading at 24.79, trading along all-time highs. But will we see the big bull breakout? Copper up 228 basis points, trading at 404. Uranium flat on the week at 81.40. And the U.S. 10-year Treasury yield down 8 basis points, trading at 391. The key news to watch next week, we have the FOMC meeting minutes, Jackson Hole Symposium, and the European Manufacturing and Services PMIs. This week's feature interview guest is Quadriga CIO Diego Parrilla, discussing market volatility, the carry trade, and the current market conditions. Eric's interview with Diego Parrilla is coming up as MacroVoices continues, right here at macrovoices.com.
And now, with this week's special guest, here's your host, Eric Townsend.
Joining me now is Diego Parrilla, CIO at Quadriga Asset Management. Diego, it's great to get you back on the show. It's been quite a while. Needless to say, I think what's on everybody's mind these days is, okay, what exactly just happened? It was a yen carry trade unwind because of a BOJ policy decision. Oh, wait a minute. They changed their mind. They took it back. Does that mean it's all over? Is this just a correction now? Or are we headed higher? Or is this just the beginning of a bear market? What should we think about this big risk event that's just happened in the market? And is it over yet?
Yeah, thanks, Eric, for having me back. And for sure, I think what happened is, the result of a number of drivers. I mean, first of all, we've had a period of what I would consider to be artificially low levels of volatility. And that has contributed to a number of dynamics, including very successful and crowded carry trades across the board, where the Japanese yen happened to be one of the preferred, but not the only funding currency. The other major factor, obviously, is what I would consider the bluff on Japan's idea that you can actually print and borrow your way out of problems ad infinitum. And that bluff's been called. Japan's been leading the monetary and fiscal abuse for the past few decades with zero and negative nominal yields and extraordinarily high levels of government debt, basically driven by this view that the enemy is deflation and you can literally print and borrow as much as you want without any severe consequences. And so what's been playing out, for the last couple of years is a reversal of some of those dynamics with effectively inflation post-COVID being obviously a clear problem. Countries and economies like the US aggressively hiking at a pace in size that had literally no precedents. And people like Japan lagging behind big time, totally unable and unwilling, but mostly unable to do something about it. And that widening rate differential, that inflation, that all these factors contributed to pretty much a one-way depreciating yen in a low vol. So if you add the low volatility trend, wide carry, and this spiral of devaluation that leads to dynamics that are effectively very difficult to revert, I think they got into a position that got to a bit of an extreme. So the BOJ, I think, Central Bank of Japan, they're back against the wall. They effectively took the decision to unwind yield curve control. For me, that was really a pretty major point in the fate of Japan, because effectively, with the level of debt that they have, to pretend that they can let long-term yields to go up somewhat freely is science fiction. It leads to a situation where, as these long-term yields or yields in general go up, and you have too much debt, they could result into what I call, an LDI squared. I mean, you might remember the crisis in the UK where we had higher yields, weaker sterling. And this situation, got Japan to extreme levels in dollar yen, which effectively forced intervention for the nth time, and were potentially opening the door to forced repatriation or other more extreme measures. I think once you go into the hikes and the market starts pricing them out, and those actually materialize, I've seen some of these skeletons in the closet come out. Volatility increases. And there's a clear bubble-anti-bubble relationship here between volatility and prices. And the CTAs, I think trend followers are big drivers of both moves on the way up and down. And the move in the Nikkei, it's somewhat a bit of a zero-sum game in total return terms, because a lot of the strength that we saw in the Nikkei that everybody felt very happy about, effectively reversing multi-decade cycle and making new all-time highs, was largely driven by yen weakness. And so it shouldn't be a surprise that as the yen unwinds and strengthens, then you have this dynamic in the Nikkei. So to keep things equal, a 20% down move in dollar yen and a 20% up move in the Nikkei or vice versa lead to effectively neutral total return game. So I think that all that went to expose that obviously the central bank had to step in, refrain, or control a little bit some of those expectations with hikes, because I think what we're seeing is the reaffirmation of the big thesis of the anti-bubble. If you abuse monetary and fiscal policies, eventually the degree of freedom is inflation and the currency. And in some ways, what we've seen is, as Mike Tyson would say, everybody has a plan until they punch you in the face. And I think once you see your currency moving, but worse than that, you see your equity market collapsing and doing 12.5% in a day, worst day since 87, and a 20% drawdown in a few days, then obviously forces people to react. So my sense is implied volatility is picked up. It's still at reasonably high levels. We're off the highs, but it's still high. But if you look at the VIX and other markets, that's already easing fast. So my sense is that the carry trade is very much alive. The position has been cleaned significantly. Depending on who you ask, you might hear that that's been reduced to by 75%. And so my sense is dollar yen is going to go back up with a weaker yen as volatility consolidates, and some of these dynamics that we've discussed with rate differentials and others and inflation and continue to play out. So I think this is a bit of a canary in a cold mine. You get, again, every time you have artificially low volatility and artificially high prices or vice versa, they can last for a while. They create a lot of complacency, but when they unwind, they can do it in a very fast and vicious way, which is what we've witnessed. And, I think whilst the position is now much cleaner, and probably we'll see that, some of these moves going back to where we were before, there's a bit more caution and perhaps a few people licking their wounds. But yeah, I think the fundamental picture hasn't changed. The big framework has been reinforced. And there are a lot of structural issues in the system that we need to be mindful about.
Diego, I want to let our listeners know that we're recording this interview on Monday morning, so it will be a few days old by the time they hear it on Thursday. As we're recording, the S&P showed its first close on Friday above its 100-day moving average. As we're speaking mid-session on Monday, looks like it's so far headed for a green candle. Maybe the recovery is on. How should we think about this? Is this, okay, the bad weather is behind us, it's time to look ahead, or is it more of picking the level where to hedge in case there's more bad weather to come?
Well, personally, I think the path of most pain for trend followers was they were max long at the top. This is always the case. You have low level of implied volatility, such as the VIX. Markets are high. People are very levered. And then these very sharp moves in terms of volatility and price, which follow a bubble anti-bubble relationship, effectively send value at risk through the roof. They create, very mechanical process of forced liquidation, and they feed on themselves because you have this basically sell-off in prices feeding to higher volatility and forcing risk down until eventually things start turning around. And so in that sense, from a CTA perspective, if you're a trend follower, this is not a lot of fun. I mean, if your model has been triggered and we've had pretty huge moves in terms of direction, many of these players have been whipped around. And you could argue that some of these, nothing's happened. You went on holiday for a week, you come back and you can barely notice. But the reality is there's been bit of a massacre for a number of people who've been taken out at the lows, and they're in some ways their model is forcing them back in. So in that sense, if you were to see the market as a pain finding machine, it's doing a pretty good job with some of the strategies that were working really well for a long time, such as carry and trend. If you actually think about the bigger picture and the narratives that were used to justify some of these moves. We talked earlier about monetary policy and imbalances and structural imbalances like Japan. But if you think of the forward-looking picture in terms of the risks of recession and what it means for equities, both in terms of earnings and other drivers, there are also reasons to be concerned. And I think the pressure is likely to be for lower. And you look at the absolute levels of valuations, and they're pretty huge and pretty high. The obvious other factor here that has been distorting the picture dramatically and is very difficult to pin is it's the AI side of things. Are we looking at a bubble, and how is that contributing to the move on the way up and potentially the virtuous cycle on the way up and the vicious cycle on the way down. And that I think adds volatility. Here again, it's impossible to, I don't have a crystal ball. I don't know exactly what's going to happen, but certainly many of these drivers are potentially showing excess. And so to the extent that 2 + 2 = 4, and, you might think that things could normalize eventually, I would think that from that fundamental perspective, the risks are skewed for lower. That could happen in a more orderly manner or in a less orderly manner. And obviously we need to factor in mommy and daddy, the central banks and the governments and how they're going to react to this. And, in that sense is somewhat concerning that the market's already pricing so many cuts, right? And I think the U.S. curve, is looking at over 8 cuts priced in the next couple of years. You could read into that in different ways. You could think, is this, we won the battle in inflation, we took rates where they needed, the world's in a great place, and let's go and basically cut proactively because, it's a great world. Or you could take the other view and say, oh my God, things are really terrible and we're going to need these cuts. You could read into it, time will tell. But yeah, I think looking into equities for sure, some of the pain has, through this high vol has materialized and already destroyed a few strategies and a few people, and perhaps, might be a bit of a warning. And it's, it's only as of time of recording, been a week since the big day, and it's pretty shocking, or not, that we're pretty much back to where we were in many of the indicators as nothing happened. But yeah, this memory effect on volatility and perhaps the sensitivity and reactivity of the market to different price moves and not just implied, but also the high realized volatility can actually test some of these dynamics. There are multiple other factors here at play that we as macro guys, monitor very closely, such as geopolitics, and that's another one that it could snap any minute, and the market doesn't really and sometimes pay as much attention as perhaps it should, given the direct and indirect consequences that it has.
Let's move on to inflation next. We've had every view imaginable, from the bottom is already in and it's secular inflation from here and look out, it's going to get worse, to no, this is just the beginning of a deflationary move, and we're headed back towards a deflation situation in coming years with negative yields and so forth. What do you think about the big picture? Where do we stand in this whole inflation story?
My view is that inflation is structural and is going to stay structurally high, but we need to make a few points first. I mean, the first point I always make is that we tend to refer to inflation as if it was this single number, absolute truth with 3 decimal places. That's it. That's gospel, right? And the reality is that your inflation basket, Eric, is different from mine and different from pretty much every listener here. So I think about inflation as just one single number is ludicrous. The second one is that, as a corollary of that point, this basket can be grossly manipulated. And so official inflation, I think as a rule of thumb, I tend to talk about real inflation, real average inflation, being at least twice the official inflation. And the other factors here is that this battle on inflation obviously has more cyclical aspects, whether commodities, there's a recession or whatever, and more structural drivers. And I think both sides of the camp can be correct. I mean, you could have cyclical drivers that effectively result in weaker demand and weaker price action and de facto deflation. But the problem is that from a big picture perspective, the situation is so fragile from the excessive debt and abuse of monetary and fiscal policies that if you ask me, it's pretty clear that the world's going to need more printing, not less, and it's going to need more debt and not less. So structurally, if we think about emerging markets as, perhaps the leader of what's to come, very often we used to, I hear and people talk about the Japanification of the world or the Argentinification of the world. My view is you're seeing the Argentinification of Japan. And we've seen that with the UK. I mean, theoretically, developed markets behaving like wild emerging markets, and emerging markets, having learned from their lessons. So I think when it comes down to inflation, again, both camps can be correct. Don't let the short-term dynamics fool you. The world's going to need significantly more printing and more debt. Things like yield curve control that we pretend that we can live without, in my view, they're coming back, yes or yes. It's the only way in which we're going to be able to control long-term yields, and that means more printing. And there's a trade-off here where we are transforming what is de facto a bubble in credit and duration and many things into inflation. That's the process. That's what yield curve control does. And so I think, again, my view is the end game here is clear, and it's that central banks and governments will always react the same way to trouble. In the short term, they try to do the right thing, but either when the bluff's called or the reality hits them, then they always resort to the same. And that has been the case, whether there's financial crisis in the banks or energy crisis through subsidies or a government crisis or any other crisis you can think of. It's always the same set of answers of money printing and debt that look to try to solve these problems. But the fact is they're not solving them. They're just delaying, transferring, transforming, and enlarging them. And that's, I think, why inflation, and in other words, the purchase power of people is decreasing by the day. And I think the other very, very important dynamic in inflation is we have to differentiate between inflation and inflation expectations. And to keep things simple, I would argue that in a world of low inflation and inflation expectations, central banks are in control. But once inflation, but more importantly, inflation expectations get out of control, and people start, as frogs in this monetary broth, start jumping off of that fixed income market, and things that are effectively are losing purchase power by the minute through inflation, especially long dated stuff, then central banks have no choice. And I think that's really what happened back in the day when we saw these desperate hikes, incredibly aggressive. Keeps, coming back to my mind, those words from Powell, we're not even thinking about hiking interest rates. And not so long after, they're making these cuts.
Diego, let's talk a little bit more about those cuts, because in the immediate wake of this correction and the carry trade unwind and so forth, the market started pricing as many as 4 or 5 cuts this calendar year from the Fed. I think that's softening now. How do you see it? Do we really have a big cutting cycle coming?
Yeah, that's what the market's saying. Is very aggressive. I think clearly monetary policy is not absolute. You're looking at also the relative, and people like Europe have already started cutting, and we might be doing it for slightly different reasons. But I think, as we were saying earlier, I think this could be the reflection of we won the battle or we're in trouble. This price action is we're in trouble. We need the support. We need to stabilize the market. Those cuts and those lower rates are effectively doing that. They're effectively providing support to risk assets. And so every time mommy and daddy come and save, that central bank put, I think right now with this current level of nominal yields and the duration of the bonds, we are in a situation where fixed income is actually defending the portfolios. The 60-40 portfolio under this sort of scenarios is working, in the sense that losses in the equity are being somewhat protected by fixed income. But there's limits to that, and there's also a scenario that is more worrying, which is the cold drawdown risk, which is what we saw in 2022, equity down, fixed income down. So I think the fact that we're already using some of these bullets that are already priced in gives us less room, and it shows you also how quick the market is asking for help to mommy and daddy, and fully understanding that they're going to be there to support it. But again, this is just reinforcing this cycle, and it's not really solving the problems. It's kicking the can, delaying, transforming, and in my view, enlarging. So we're just not out of the woods at all.
I want to come back to what you said earlier about your view that inflation is going to run maybe as much as double what the reported value is. It seems to me if you have that variant perception, there's trading edge to be found there, in the sense that most market participants are going to be trading from approximately the official data. So if you have that view that real inflation will be much higher than reported inflation, what's the trade? Is it long commodities? Is it something else? How do you benefit from that?
Yeah, I think real assets ultimately have that edge. I think in the short term, you can fool people by pretending that inflation is effectively much lower than it really is. And central banks have this first mover advantage, and the governments, they're the ones who are printing the money, they're lending it, they're borrowing, and they're using it and they're spending it. And so they are the big beneficiaries of a world of their incentive is to try to print and borrow and spend as much as they possibly can, whilst let's say inflation is not picking up. Scenarios where the economy is running slow gives them even more room to do it, and then these things effectively accumulate in the system. But eventually they show up. And they show up in multiple ways. And we see pretty unhappy people out there with scapegoats that you don't know who to blame. And that's kind of the sad thing. We see people losing purchase power. It's very difficult for people to actually pinpoint and say this was some central bank just printing money like crazy. It's very easy to find scapegoats and to blame for these prices. And that brings us into all sorts of political dynamics that we're seeing, from social unrest to obviously polarization and wars, which I think I tend to dedicate my second book as, I hope you like it, I hope I'm wrong, because I do feel a bit like a doctor diagnosing this terrible disease to a friend. As a friend, you want to be correct. As a doctor, you want to be right. And I think this dynamic is playing out. So yeah.
Diego, let's move to energy prices next, starting with the big picture outlook of what you see globally for energy prices, but also more specifically, since you're in Europe and have that perspective and just mentioned this growing geopolitical tension and escalation, I guess you could make one argument that, hey, there's plenty of spare capacity. OPEC's holding 4 million barrels off the market right now. We don't have to worry too much about energy prices to, wait a minute, things are happening so quickly geopolitically that you just have no idea what could happen next. And maybe as we go into the winter season, we could be looking at a very risky situation for Europe, particularly in terms of energy prices. So is this a time to relax into spare capacity or a time to worry into geopolitical escalation?
Well, it's a bit of both. I think the energy market is very complex. If we start, I think the first point I would make is that, we tend to look at crude oil and Brent in particular as sort of the main key benchmark for global energy prices. It's very important to know that crude oil historically has been primarily a transportation fuel. We use, gasoline, diesel, jet fuel to basically move from point A to B. And in that sense, there's been historically very little direct competition for crude oil in that side. So to the extent that transportation is critical and crude oil is the main guy, we need to pay a lot of attention to it. But there's an equal, if not more important side of things, which is other energy uses such as, industrial and others. So let's start with the transportation side. As we're speaking right now, Brent is above $80 a barrel. And what the market's telling us is in what we call the shape of the market is in backwardation. So effectively, the futures are below the spot market and they go down gradually to some sort of bottom medium-term price of about $70, which happens a few years out. So in that sense, the market is telling you that there's some sort of premium for immediate availability through higher prices, and the market seems somewhat relaxed about the medium long-term pricing. If you actually think about other critical energy sources, and I think here we need to look at natural gas in particular. Natural gas is hugely important. It's a key input in electricity prices, in industrial processes. And unlike crude oil, which is very much a global commodity, so we all pay roughly the same prices pretty much everywhere in the world for that crude oil, which then gets refined into products and you pay different end prices for the product. Natural gas is a very, very regional commodity. And the U.S. Natural gas market, the Henry Hub as a benchmark, the domestic prices are currently trading a little bit over $2/MMBTU, which means nothing to most people. But if you compare it or convert it into barrels of oil equivalent, we're talking about roughly $12 a barrel of oil equivalent. So natural gas is extraordinarily cheap on a relative basis to crude oil in the U.S., but the geopolitical dynamics that you were mentioning, Eric, and you think about more global natural gas prices, which you track through what we call LNG, liquefied natural gas prices. You take the gas, you liquefy it at very, very, very minus 200 odd degrees, and then you transport it and then you regasify it. That's the way you can move gas from point A to B around the world without pipelines. That gas is actually trading very close to crude oil levels. It's more in the almost $75, $80 per barrel of oil equivalent. That means that Europe and Asia are paying dramatically higher prices than the US for such a key input, which drives the competitiveness of the countries. Should the situation in Russia, Ukraine worsen further, and should the Middle East situation impact these dynamics further, both on the LNG or crude side, the situation could get even worse. And so Europe and Asia, and this is something that I've been highlighting for a long time, the energy competitiveness of energy, the U.S. market relative to the rest of the world, it's been, in my opinion, a very significant factor that has contributed to the stronger U.S. economy on a relative basis to the rest of the world. And that situation is still there. Things like, the U.S. effectively dragging their feet and not allowing this domestic natural gas to be exported, create or give licenses for LNG is effectively ensuring that the U.S. keeps that edge. In a scenario where there was sufficient capacity in the U.S. to liquefy and export that gas, then LNG prices would be global. It would be probably closer to the lower end of the spectrum, and that would put significant pressure to energy as a whole globally. And let's not forget that LNG, whilst might be used for more industrial and other uses, can also and is actively being used as well for transportation, which is part of the reason why perhaps the very long-term picture for energy is not as negative from a supply and demand perspective as you might think. But on the other hand, we have all this monetary phenomenon that is playing out, which effectively means that asset prices are going up, not because they worth more, but because the currencies we used to pay them are worth less. And that, I think, brings us into a very interesting dynamic in energy markets where OPEC has been, playing their hand really well. OPEC, by effectively limiting their production and keeping spare capacity, and they've managed to take the market where they want it. They've made the inventory situation tight enough that they sent the market into backwardation. They have the ability to respond. They could tighten things more, and they're also doing it in a way that there's no panic in the long term. Previous crisis, like 2008-7, where crude was 120, we were in contango, and that pretty much invited people like the Canadian oil sands or others to come in and enjoy the ride. So this situation is different, and it's some of the new potential solutions or like shale or others or the long dated stuff is not that obvious that they come in, and that gives OPEC a very strong position. So net there are forces in both directions. I think the market is probably priced about right. Should there be a major geopolitical escalation, certainly the energy markets will react aggressively. But barring that, I think the situation is there's no panic in terms of the availability of this in certain parts of the world, but others are tighter. So again, OPEC playing a very strong role in this complex dynamic.
Now, just as we're recording this interview on Monday, mid-session, there's another set of rumors out on the internet that, the big retaliation from Iran against Israel could be coming in the next couple of days before this interview even airs. How do you think about this? Because I've heard a couple of different views. Dr. Anas Al-Haji has said, look, there could be a very big escalation with Iran, but what's different this time is the other Arab states don't really want to back Iran. They want to de-escalate. They're not going to play the oil card. But the other side of that, of course, is, look, if you get to a U.S. versus Iran direct conflict, it's kind of hard for that not to be a major dislocation in energy markets. What do you see if there is an escalation of this Iran conflict, and if we get to the point of a direct U.S.-Iran military conflict, is that a really big risk event for oil prices, or is it not that big of a deal for the reasons that Dr. Al-Haji mentioned?
Well, it's a pretty huge deal for the world. I mean, we're talking about nuclear powers. We're talking about regions of the world that are critical, and of course, it would be pretty major. I do agree, though, that in some ways, Iran is what we saw with Hamas and all the terrible things that are happening. It's almost like a provocation for something to happen and rally, effectively the entire Arab world against Israel. If you visit the region as Middle East as I do on a regular basis, you go to places like the UAE, you will see quite extraordinary developments through the Abraham Accords and the Louvre Museum showing the unity of three, the entire message is all about, we're all the same, and how different cultures, from the Arab world to Asia to Europe to everywhere, have been effectively dealing with things like death and gold masks in a parallel fashion, forever. There's a very strong message, with the synagogues, with churches, where the architecture is done in a pretty impressive way, where they're exactly the same size, similar style, but different things. So there are, I think, incredibly positive things happening in the region, and there are people that are seeing those and perhaps trying to force a situation that will basically put their back against the walls and have to make some choice. And so it makes things extraordinarily difficult. But to the extent that the US is directly involved with Iran, I think that would be huge in so many ways. Let's not forget that as we're speaking as well, over the weekend, we had Ukraine effectively stepping into Russian territory. And again, we're talking about nuclear states. And if you're Putin, what do you do, right? I think for a while you were sort of attacking and trying to settle by keeping certain areas and consolidating as yours, and maybe saving face by taking additional territories. And now suddenly you see yourself losing ground, and how Iran and Russia play together in the role of China. This is really not something we want to see getting worse. And when you think about energy crisis, there are two key things to worry about. One is the availability of the molecules, and the other one is prices. And during the Russia-Ukraine war, we saw Germany effectively, and the whole of Europe, trying to protect itself against the prices through energy subsidies, which effectively meant we're going to cap the prices, we're going to print euros to subsidize it, and we will pay whatever it takes, and the consumer will not hurt, which effectively was a simple way to dilute the euro and print and borrow and transfer and transform and delay the problem. The second part, which is, do you have access to the molecules? We had factories shutting down because, you couldn't, beyond the price, you just couldn't get those things physically. And that has done damage that has been in some cases permanent. So it's a phenomenally important field, and, Europe is still very vulnerable. And, I don't think the US will want to get directly involved. They're the biggest beneficiary and winner of having all these wars being played far from them. And they have this major advantage of extraordinarily low natural gas prices. So I think this situation is benefiting the US significantly. A deterioration of the situation would improve the US situation even further. But if you were to go into an escalation where the US is directly involved, I think that changes the game, and it would be extraordinarily major. I mean, it would make last week's events like a walk in the park.
Let's talk about precious metals next. It seems like it was only maybe a decade ago that central bankers were very much in the habit of ridiculing gold bugs and just laughing it off, saying, look, gold is a barbarous relic that serves no place as a central bank reserve asset in today's economy. That was 10 years ago. Right now, central banks are buying gold hand over fist. What gives?
No, clearly, I think gold has played a very important role. It has, we talked about commodities in general and energy in particular just now. They are, quite different to gold. I mean, gold, it has a significant part of gold is monetary, is central bank. It is obviously a commodity as well, and it has industrial uses and other things. But yeah, I think gold, in subtitle of my book was the anti-bubbles opportunities heading into Lehman Squared and gold's perfect storm. I have long believed that the setup from a monetary and fiscal perspective is one where the end game will be, this spiral of devaluations where, the degree of freedom of the system is inflation and this currency devaluations, which we've discussed at length earlier. And I think gold is a major beneficiary of this. I think the other key factor to watch is, Russia basically invaded Ukraine, and we effectively decided that it was a smart thing to seize Russian assets and effectively challenged the freedom of money and the SWIFT system and other things, that effectively was a very clear sign for China or anyone else to say, look, if you invade Taiwan or whatever, I know you have a lot of treasuries, but those are gonna be ours or frozen. So I think that moment sort of bifurcated the world. In the sense that signal was given to open new alternative ways of decentralization. And I think gold, again, being gold and for its unique characteristics, has been a big beneficiary of that. And I think that trend could continue, but gold is gold. I mean, it will have its major drawdowns, it'll have its move up, but I think eventually I've long held the view that gold, at the time of writing, I said gold has a few $100 of downside, a few $1,000 of upside, and I still think that's the case. So long term, it has a role to play, and central banks are part of that, but they're not the only part. I think gold has, something to say in the system. It's not the ultimate solution to money, but I think the outlook for gold, in my opinion, is attractive in the medium long term. It has been for a few years, and I think still the case.
Well, Diego, I can't thank you enough for a terrific interview, but before I let you go, I want to touch on your most recent book, which is actually still several years ago. You're probably best well known for the book that you co-authored back in 2014 with our friend Daniel Lacalle. That was The Energy World is Flat. But I think the book that's probably more relevant to current markets is your 2017 book, which was called The Anti-Bubbles. Tell us a little bit more about that one. Is it relevant to today's market? If so, in what way, and where can people find it?
Yeah, look, I think first thing is you write for yourself. You try to understand, your own ideas. And I've been very blessed that, some of this work has been shared and has been helpful to other people. But I do think both were and continue to be frameworks that try to provide effectively a way of thinking about these challenges and these dynamics. And the anti-bubble framework introduced the concept of anti-bubble, which if we were to borrow George Soros' definition of bubbles, we could think of bubbles as assets that are artificially expensive based on a misconception, effectively a false belief. So from Soros' perspective, bubbles are assets that are artificially expensive. It's a matter of when, not if, that they will go down. And they're very much linked to this idea of a misconception. What I did is I generalized the framework, and I said, okay, misconceptions can distort reality, but not only through artificially high valuations, they can also do it through artificially low valuations, which is what we call an anti-bubble. So the first dimension of the concept is this idea of extreme value, assets that are grossly artificially cheap. The second dimension is, because they're both mirror images of the same misconception, bubbles and anti-bubbles will move, will implode and explode at exactly the same time with exactly the same catalyst. And that's why I called it an anti-bubble, a bit like an antivirus or an anti-missile. It's a defense mechanism against the bubble. And the third one, which is very important and very relevant to today's markets, is the reflexivity of the relationship, where artificially low volatility contributes to artificially high prices. So think of the S&P and the VIX, for example. And this happens both qualitatively and quantitatively. I mean, qualitatively is this perception that, mommy and daddy, the central bank they're there to support us. There's no risk. It's complacency. Quantitatively, we have CTAs and trend followers that effectively lever themselves up as volatility goes down, and they're forced to cut. So I think what we're witnessing today is very much reinforcing the thesis, both from a macro perspective of what it means in terms of, the fact that we're not solving problems with monetary and fiscal, we're delaying, transferring, transforming, and enlarging them, but also mechanically in terms of how we construct portfolios. The important thing and the work we've been doing in portfolio construction, I always use the analogy that investment portfolios are like football teams, like soccer teams, right? I'm Spanish. So, you have strikers, midfielders, defenders, and goalkeepers. You need to create this team where each player needs to do their job, right? So equities and credit make money, they score goals, defenders and goalkeepers defend, and there's a very important role. But then together, they can effectively compound through rebalancing alpha. So I think all this framework, again, it's, I think, quite relevant. Beyond the books, people can just reach out through Twitter or X, Parrilla Diego, RRL, or LinkedIn. We run monthly newsletters and calls, and we run some strategies that might be eligible for some people, and I'm very happy to share details.
Well, Diego, thanks so much for a terrific interview, and we look forward to getting you back in a few months for another update. Patrick Ceresna, Nick Galarnik, and I will be back as MacroVoices continues right here at MacroVoices.com.
Now, back to your hosts, Eric Townsend and Patrick Ceresna.
Eric, great interview with Diego. Now joining us again in the post-game segment is Nick Galarnik. Now let's get to that chart deck. Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means you have not yet registered at macrovoices.com. Just go to our homepage, macrovoices.com, and click on the red button over Diego's picture saying looking for the downloads. Now, Eric, let's just start off with crude oil and the EIA inventory.
EIA printed a build of 1.4 million barrels of crude oil, but hold on, the crude oil build was the only build on the board. Cushing, Oklahoma drawing down 1.6 million barrels. Fears are growing of tank bottoms, and despite the higher flat price, we're starting to see the term structure, meaning the backwardation, pick up again. The big drawdowns were in finished products. Gasoline drawing down 2.9 million barrels, and distillates drawing down another 1.7 million barrels. That's a net petroleum drawdown of 3.2 million barrels. Again, a drawdown, despite the fact that the headline crude print was a build. U.S. production ticked back down to 13.3 million barrels. That's the plateau level that we've been holding for several months. Let's see if we can get a trend going above that level. We saw a big 10% move off of that recent bottom, which was right around the 200-day moving average at 71.76 on WTI. We saw a fresh 6-month low this week on Cushing inventory, and that's no joke. Remember, we need to have that operating volume of at least 25 million barrels or so of physical crude oil in Cushing, Oklahoma, in order to be able to blend different grades together and so forth in order to supply the country with the oil that it needs. So it's no joke that we're getting to fears now of getting below that operational minimal level. There's plenty of good arguments to be made for why perhaps there's a new structural bull market in play, and plenty of reason to also fear geopolitical escalations, which could take that bull market even higher. Just take a look at Wednesday's tape action, selling off hard despite the net petroleum build, the 6-month low on Cushing inventories, and the looming risk of a major escalation in both the Ukraine and Israel-Iran war theaters. Hot inflation print could potentially also add to the bull case, at least in the long term. But it's hard to chase this move now. I missed the 71 handle bottom, so I'm not rushing back in on the long side of this trade to chase it. If we get another test back down in the low 70s, well, maybe I'll start to think about a strategic long at that point. But given the uncertainty and the risk of a significant recession, it's really hard to justify putting much leverage on in either direction here.
Yeah, Eric, I wanted to just show on page 2 that chart of crude oil. And really, I tried to zoom out and capture a couple of years in here, because what I wanted to really highlight is that oil really has been in almost an 18-month trade range, more or less capped between $70 up to $90. And we find ourselves basically trading right in the dead center of that 18-month range. Oil is lacking conviction to the downside or the upside. And I think that this trade range will continue to prevail on the short term. Clearly, there's a catalyst that if there was some sort of escalation in the Middle East, that there could be a right tail move, but that can't be assumed to be the most probable outcome. It's simply a risk that could bring oil very quickly to the top end of this range. There's not much to say about this other than let's see whether or not it can make it to the highs of the summer. Now, let's get Nick involved in this conversation and talk about the equity markets here. Now, Nick, the S&P 500 continues to bounce after that carnage. What are the levels you're looking at S&P, and what are your thoughts?
Yeah, Patrick. So right now, spot price on SPX is approximately $54.90. And we have an implied move for the September 20th monthly OPEX of plus minus 200 points. Therefore, we have an upper implied move of 56.90 right near all-time highs and a lower implied move of 52.90. Right now, we have key resistance at 5,500 and key support at 5,300. I'm inclined to think, given that we've seen soft PPI, inline CPI, and better than expected retail data, that we've seen upward move toward that 55.50 area perhaps before retesting a lower area of around 5,300 or so.
Absolutely. The catalyst for the sell-off was this big yen carry trade unwind, and really that seems to have completely stabilized. And in order for the sell-off to continue, there would have to be some new catalyst of negative news to come in, and it simply did not come from either retail sales or the inflation numbers. And so now the market has pretty much unwound almost all of the selling back above 5,500, where above the levels where there could be downside gamma from dealer positioning going into this week's option expiration. And so everything is settling down in here. The way I kind of look at this is that if the markets here don't sell off now, which they didn't, then we're in a likely crawl back towards a double top retest. I still think that there's a very reasonable probability that the highs that were put in July will be the highs of the year, but often the markets will do multiple tests of previous highs in a bigger topping formation. And at this stage, the last sell cycle is over. So the question now is that does the market go for a full double top retest of its previous highs? And it is on the table. I'm not super bullish, but the path of least resistance for the remainder of the summer could be that kind of a crawl higher. Moving on though to page 4 here, Nick, we have the Russell, and what we obviously had was a big jump in the Russell back in July, and they gave it all back. And what's interesting is that in spite of the big bounce in the S&P, the Russell is just right back into that trade range that it's been in all year before that breakout. What's your thoughts here?
Yeah, Patrick. So I am still bullish on the Russell up to that all-time high area of 2,400 or so. I do think we see outperformance for the remainder of the year into the election cycle as well. And I am staying along via butterfly call spreads here.
All right, Nick, I wanted to move on to page 5 to the Nikkei. This is where the crash happened. There was a 25+% drop in the Nikkei in less than a month. And we've now 50% retraced that sell-off. So it was like a bungee cord tied to the feet of it. It jumped off the bridge. The bungee cord extended and now slingshotted it back the other way. I think that at this moment, watching what the Nikkei does back in this 38,000 area will be very interesting, because if the Nikkei in any way starts heading back down to retest 35 or 34,000 to establish a bottoming formation, I think that the market will kind of pay attention to it. I don't know whether the U.S. equity market is going to be as sensitive to just short-term movement in the Nikkei as it was to the shock that came from the yen carry trade unwind. But the Nikkei, I think, on the short term is going to start hitting some overhead resistance. Finally, though, I want to just get the conversation started about the NASDAQ. We have on page 6 the QQQs. First of all, let's start off just with the levels you're watching here, bud.
So spot price right now in Qs is approximately 465. Right now, we have an implied move for the September monthly OPEX of plus minus 23 points. Therefore, the upper implied move is 488 and the lower implied move is 442. Right now, we have key resistance at 480 or so, and we have key support at 450. I think we see perhaps some buying into the earnings call for NVIDIA, which is in a couple of weeks. And after that, it's anyone's guess. But I do think that the all-time highs at 504 area or so should set a top for the remainder of the year or so.
I agree with that. And what's interesting is that even though the NASDAQ has bounced in line with everything else, the S&P bounce seems to be on a relative basis more distinct and pronounced. And that's the interesting part, is both the Russell and the NASDAQ seem to now be lagging, and the S&P 500 is where that flow is. And so let's see if that trend continues. All right, Nick, moving on to that page 7, that volatility index, what a spike that was. We only see these types of moves in market crashes, and yet the S&P was was barely off 10% off of its highs for this type of a spike into the 60s. But look how fast we mean reverted right back down. And when we're back into the teens, we're at the 16 handle right now. And obviously with a S&P 500 that's bullishly tilted in the post-retail sales number, we're finding ourselves coming right back into those trade ranges where we've been numerous times throughout the year. How do you size up the vol market here?
So right now with the VIX at about 16 handle, we can expect to see top to bottom intraday ranges on SPX of about 1% or so. And as I said in the past, buying insurance when it's cheap is pretty prudent, especially if you're holding a portfolio that correlates heavily to the S&P. And I think this is where a lot of, fund managers can learn from their mistakes perhaps and insure your portfolios when it gets cheaper again. That being when the VIX goes below 15 or so, and insurance for half a year or so out gets very, very cheap, especially when you have some nice upside in your portfolio. It's not a bad idea to buy some insurance and hedge that downside risk because, again, this was a very anomalous event that came out of nowhere and a lot of people were caught off guard and it caused some selling, perhaps some panic selling that perhaps hurt performance in the short term or so. So insure yourselves and look at buying insurance when it's cheap. Now, Eric, moving on to the US dollar, what are your thoughts here?
Louis Gav's call from last week's podcast that we might be entering a new U.S. dollar bear market seems supported so far by the tape action. We had a test of 102. That was the lowest print since March on the Dixie. We're bouncing nicely off that level, almost at 103 now. A new lower low, though, that would be a close below 102, would be a big tell. It's early to say that that's going to happen. The hot inflation print suggests that maybe those 5 rate cuts everybody was expecting this year might not happen after all. So there's room to argue in either direction here. Let's see what happens.
Well, Eric, it would be interesting to see whether the strong retail sales and other types of data points like this allow the U.S. dollar to recover a little bit, at least from a very oversold condition. But I really wanted to highlight on page 8 the U.S. dollar yen, because this really was where all of the action was. And we were quite oversold on the U.S. dollar on a relative basis. And so far, the bounce back in the U.S. dollar yen has been very benign. I think that there's plenty of room for this to even temporarily trade back towards 150 and test some areas. But the bigger question is is there another major move on the downside coming in the U.S. dollar yen in the second half of the year? And right now the bounce is underway. This is going to keep some short-term summer doldrums going, but will there be big action coming in the new year is the thing to watch.
Moving on to page 9, we have that gold futures chart. What are you guys thinking here?
The gold bull market rages on, but obviously the hot inflation print means rate cuts are less likely, and that's going to hurt gold in the short term. So yeah, I get it. We got slammed on Wednesday with more than a $40 intraday correction from peak to trough. That was on the hotter than expected inflation print, and frankly, it's no surprise and no real reason for concern as far as I'm concerned. Longer term, remember, structural inflation, which for years now I've been convinced is what's really going on here, is super bullish for gold. Eventually, the Fed won't be able to hike rates enough to fight structural inflation because doing so would bankrupt the U.S. government. When that happens, real rates will utterly collapse and gold will soar. Now, that's not happening quite yet, but already we're in a bull market. All of the moving averages are pointed up, and I'm not at all concerned about this inflation print. It's noise. Maybe we've got some more downside to go. We just had a really nice brisk swing back up to retest the all-time highs. Maybe that was a swing high and we got a swing back low again. I'm not too worried about it. This is a bull market. Let's give it room to breathe and not be discouraged if more hot inflation data in coming days and weeks adds a few more stumbling blocks for this bull market to overcome.
Eric, when looking at this chart, the pattern is very clear. It's in a bull trend above its moving averages. The pattern of higher highs and higher lows is persistent, and this at this point continues to look like it has the potential for a bull breakout.
Moving on to page 10, we have that uranium chart. Eric, what are your thoughts here?
Well, the market is likely bottoming here, but I've said that before a couple of times in this podcast, and it actually had lower to go. Might still be the case that we still have lower to go, but at the end of the day, what matters is we need to see trading volume pick up on the very thin, quiet summer uranium spot market, which sees almost no volume in the dog days of summer. Until that volume comes back into the market, we shouldn't expect higher prices on the mining shares. Spot uranium has not sold off below $80 despite the almost nil trading volume. And that means that when the buyers do return, there could be a brisk move to the upside. SPUT, that's the Sprott Physical Uranium Trust, is holding its own even as the miners continue to sell off. And more so, SPUT trading below 15% discount to its NAV. That's, you can buy SPUT and effectively buy physical uranium for 15% off of the already low $81 spot price, or $81.50, I think it was today. That's an amazingly good deal. In the past, anytime we saw a 15% discount to NAV on SPUT simultaneously occurring with a sub-30 RSI, that's historically marked market bottoms within a few percent. But markets love to make fools of as many people as possible. So who knows, maybe there's another spot market head fake below 80 that could panic everyone and freak out even more retail investors, causing them to abandon their positions in the uranium mining shares. Yeah, if that happens, it's just an even better opportunity to buy, and I'll certainly be buying it. The World Nuclear Association conference in London, September 4th through 6th this year, has in the past been a really big bullish or seasonal catalyst, kind of kicking off the fall contracting season. So we may have to wait for September before we see higher numbers in this market. Meanwhile, I look forward to meeting some of you at the World Nuclear Association event in London.
Yeah, Eric, it really just has not gotten any love yet. At some point, there's going to be a turn in the charts and flows are going to start to show that a new bull cycle has begun. But right now, there really isn't a pulse to be found. It'll be interesting to see what will be the ultimate catalyst to restart things up in the uranium space, but it's certainly not here yet. Finally, I just wanted to touch on the U.S. 10-year Treasury yield on page 11. What we really saw was a massive drop in yields during that whole event. And now with a retest and strong economic data in the U.S., it might be a scenario where we crawl back above 4% here on a short-term basis and even maybe see levels as high as 4.10, retracing back toward those moving averages. In general, I think that bonds will continue to be a safe haven during these periods, but with such an extraordinary move in yields over the summer, them mean reverting back into the midpoints of where they were trading is not out of line.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com. Patrick, tell them what they can expect to find in this week's Research Roundup.
In this week's Research Roundup, you're going to find the transcript for today's interview, as well as a chart book we just discussed here in the postgame, including a number of links to articles that we found interesting. You're going to find this and so much more in this week's Research Roundup.
Well, that does it for this week's episode. We appreciate all the feedback and support we get from our listeners and are always looking for suggestions on how we can make this program even better. For those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com, and we will consider it for our weekly distributions. If you have not already, follow our main Twitter account @MacroVoices for all the most recent updates and releases. You can also follow Eric on Twitter @EricSTownsend. That is Eric spelled with a K, and follow Patrick @Patrick Ceresna. On behalf of Eric Townsend, Patrick Ceresna, and myself, thanks for listening, and see you all next week.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.